Hello, everyone. Welcome to another edition of Joe's Financial Fundamentals. Today, I'm going to talk about some of the factors to consider when deciding to buy a rental property. We will review the spreadsheet template I've put together that you're looking at now and look at several different options. Please note that I'm not advocating one option being better than the rest. You would have to plug in the most relevant data for your situation to determine the best path forward. I would also give a lot of weight to your risk profile and how this decision fits into your overall investment portfolio. Please also be aware that I'm not a financial professional and this information is presented for educational purposes only. Please do your own research and/or discuss any financial decisions you are considering with a professional. So let's look at what I put together here in this model, and kind of follows the same format as some of the other models that you may have seen in previous videos, but I'm assuming now that you have cash. You're deciding on whether or not to buy a rental property. So basically you have two options here. You can invest that cash, or you can use the cash for a down payment, take out a 30-year fixed rate mortgage to buy the rental property. So the different variables here in green, the fields in green, would be the purchase price of the rental property, any fees like HOA, property tax, insurance, your rental income after any fees, how much it costs you to maintain the home, and any annual increase in rent, taxes, insurance, fees, and home value. I just lumped those all together. On the mortgage side, you have a down payment you're going to make. Here I plugged in $25,000 down payment, just 10% of a purchase price of $250,000, and what your interest rate would be. And this calculates your monthly payment. And again, it's a 30-year fixed rate. The last variable is the investment performance. So the money that you invest in option one, where you do not purchase the property, what return are you expecting? You can see after 30 years that in this scenario, with these numbers, again, I'm not advocating one option being better than the other, just showing you the illustration here that it does show that purchasing the rental property is more lucrative. By the way, I've never purchased a rental property in my life, so I do not have any firsthand experience in it. And I know there's a lot of information out there on the internet, but again, I'm kind of trying to impress upon you to do your own research, do your own analysis, be a little bit leery of what other people are telling you. Might be biased based on them, maybe what they're trying to gain from you participating. I do not include any tax ramifications, which may or may not be significant. And so, basically, when I was a little surprised at the disparity here, and when I dove into the numbers, and not to get too far into the weeds here, but a lot of the option, what I'm calling option 3 here, which is really the purchase of the rental property, that value, see, after 30 years generates a value of $815,000. Most of that is the value of the home itself. So after 30 years, you own that home free and clear. And if you started out at $250,000 and you grew it if it grew at 3% a year in value, at the end of 30 years, that's a significant number, over $600,000. So that's most of this total value. Whereas if you invested that money, the $25,000, instead of making the down payment on the home, and you got 10% a year, you can see at the end of 30 years, you'd have $436,000. The other thing I'd point out that I didn't really do a deep dive on, but it's something you're going to want to do in your situation, is look at your monthly cash flow. And for a lot of the first few years here, it's a negative cash flow, meaning you're paying more in taxes, insurance, maintenance on the home, and also your mortgage. The mortgage calculations, by the way, are down below here. So you're paying more for these items than you are taking in revenue. Over time, that does flip a little bit as you make, again, you're raising the rents hypothetically, and your interest payments, your interest on the mortgage goes down every month. So again, that's just a quick overview of some of the variables to use. I did run another scenario. I'm going to switch over to that one here. It's similar, but what I said was, let's say you have a lump sum of, in this case, $250,000, in cash, and you want to decide to invest it or use that amount to buy a rental property. So you really have three options: invest the cash, do not buy the property; buy the rental property in an all-cash deal; and buy the rental property and take out what I put in here was a 15-year mortgage and invest the rest. And in that scenario, same variables here. And again, anything in the green can be changed. But in that scenario, option one of just investing that cash came out fairly close to the option of, again, taking out a 15-year mortgage, putting a down payment, investing the rest. So as if you change these variables here, for example, let's say don't think you get 10% a year. Let's say you might think you get 7% a year. You can see in the graph here these numbers change, and the relationship change. Same kind of thing holds. You want to look at your monthly cash flow. I was also struck by buying the rental property and using all of your cash to buy it outright actually did not turn out to be, over 15 years, did not turn out to be the best scenario. So in summary, you can consider using this type of model as a starting point in your analysis. And if you're interested in receiving this model for your own use, please drop me a comment. I have a lot of other templates here that I've put together. You can see across the top that I've referenced in previous videos. So I hope that was helpful and of interest to you, and have a great day. Talk to you soon.